Hey, welcome. So, you've got a life insurance policy, and that time of year rolls around. Tax time. And you start to wonder, hey, can I get a tax break for this? It's a great question, and we're going to get you an answer right now. So, let's just cut right to the chase. You're paying those premiums, you're doing the right thing for your family or your business, and that little question pops into your head. Can I actually write this off? Is this deductible? For the vast majority of people out there, folks with a personal policy to protect their family, the answer is a pretty straightforward no. Sorry, the IRS just doesn't let you deduct those premiums. But don't click away, because the why is important. And more importantly, there are some really interesting exceptions. And this is where it gets good. If you're a business owner, if you're self-employed, the game changes. That hard no suddenly turns into a, well, sometimes. And that's exactly what we're going to unpack. Okay, so to really get when you can deduct it, we have to be super clear on when you can't. So let's start with the baseline, the rule that applies to almost everyone, your personal policy. You see, the IRS basically puts life insurance in the same bucket as your car insurance or your homeowner's insurance. They see it as a personal expense. It's a choice you make to protect yourself and your family, not something like a business expense that the tax code is set up to reward. And really, it comes down to this big trade-off. On the one hand, nope, you don't get a tax deduction for the premiums you pay today. But here's the massive upside. When that policy eventually pays out, the death benefit goes to your loved ones, and it's almost always completely income tax-free. And believe me, that is a huge, powerful advantage down the road. All right, we've got the personal stuff down. Now let's jump into the world of business owners. This is where it gets a little trickier, for sure, but it's also where the opportunities for a deduction actually pop up. Now, if you remember one thing from this whole explainer, make it this. This is the golden rule. If the business both owns the policy and is the one getting the money, the beneficiary, then you absolutely cannot deduct the premiums. The IRS's logic here is simple. They don't want you getting a double benefit, a tax deduction now and then a giant tax-free payout later. The perfect real-world example of this is something called key person insurance. Let's say your business relies heavily on a brilliant founder or a top salesperson. You might take out a policy on them. If they pass away, the business gets the money to stay afloat. But because the business is the beneficiary, those premiums are not deductible. Simple as that. And this rule applies across the board. It doesn't matter if you're a solopreneur, a self-employed person insuring yourself, or if you're running a bigger operation like an S-Corp or a C-Corp. Even with fancy-sounding policies like COLI, which is just corporate-owned life insurance, if the company gets the check, the company can't deduct the cost. So after all those no's, you're probably wondering, okay, so when on earth can a business deduct these premiums? Well, here's the secret. You have to change who it's for. It has to be a benefit for your employees, not for the business itself. All right, I want you to remember this number, $50,000. Just lock it in your brain. This number is the magic threshold set by the IRS for the single most common way a business can offer a tax-deductible life insurance benefit. So here's how that works. With what's called group term life insurance, Step 1, the business pays for it. Step 2, as a result, the business gets to deduct the premiums for any coverage up to that $50,000 mark for each employee. And Step 3, this is the crucial part. The employee's family gets the money, not the business. That's what makes it a legitimate deductible employee benefit. There's another really cool option, too, that companies use to keep their top people happy. It's called an executive bonus plan. With this, the company pays the premium on a policy, but the policy is actually owned by the executive. The business gets to deduct that premium, but it does it by calling it what it is, compensation. It's a bonus. Now, the executive does have to pay income tax on that bonus amount, but they're getting a super valuable life insurance policy out of the deal. Whew, okay, we've gone from personal rules to the nitty-gritty of business strategies. So let's just pull all this together into a quick, easy-to-read summary. This chart really says it all. Let's just run down the list. Your personal policy? That's a no. Why? It's a personal expense. Key person insurance for your business? Also no. Why? Because the business is the beneficiary. Now for the good stuff. Group term life? That's a yes, as long as it's for your employees and you stay under that $50,000 coverage limit. And finally, an executive bonus plan? Also yes, because the key is that it's treated as employee compensation. So the bottom line here is pretty clear. The details matter a lot. Who owns the policy, who gets the money, how it's classified. These little details are what makes the difference between a deductible expense and a non-deductible one. Getting that structure right is everything. And that brings us to the final and maybe most important question, the one you should be asking yourself. Take a hard look at your own life insurance policy. Is it truly set up in the best, most tax-efficient way to actually meet your goals, whether they're personal or for your business? If you're not 100% sure about the answer to that question, or maybe you just want to see what's out there, we can help. Here at The Annuity Expert, we help people compare life insurance quotes and figure out the right strategies. And our help is always, always free. You can give us a call at 770-755-1565, or just find us online at annuityexpertadvice.com. We're here to help you get the clarity you need. Thanks so much for watching.